Okay, so then let's go. Someone should assist with the reading.
The data below relates to Odoneho plc, and they are in respect of the production of its product, Milcho, for the first quarter ended 31st March 2022. Budgeted output is 5,000 units. Standard hours to produce 1 unit is 2. Budgeted fixed production overhead is 25,000 Ghana cedi. Actual fixed production overhead incurred 25,840 Ghana cedi. Actual hours worked 10,500. Actual units produced 4,980. Required. Determine the following. I. Fixed overhead expenditure variance. II. Fixed overhead capacity variance. III. Fixed overhead efficiency variance. IV. Fixed overhead volume variance. V. Fixed production overhead variance.
All right, so it's all about the fixed overheads. So let's quickly run through. Okay, all right. I think we can start now. So the first thing we are asked to do is fix overhead expenditure variance. So fix overhead expenditure variance. So what is the formula? It is the cost variance, fixed overhead cost. Oh no, this is expenditure. So the expenditure variance is what? Budgeted fixed production overhead
Production overhead
minus
minus
actual fixed production overhead
actual fixed
cost.
production overhead.
Correct one. So if you want the budgeted fixed production overhead, where is it? So we check from the question.
Mm. The
So we have
third one.
the third one budgeted. Oh, correct one. 22,500. And the actual Actual fixed
This
production.
is,
I think the fourth, so
sir,
it's the
please, it's
fourth one.
25,000.
Oh, okay, sorry. And then we also have what? 25,840, the actual.
Yeah,
So that gives us what?
840.
840. Adverse or favor?
Yes.
Then from there we have what?
Okay.
Fixed production,
Okay. That is cost.
overhead, capacity, variance. So capacity, what's the formula? Budgeted hours minus
Minus standard.
no, minus actual hours.
Capacity.
Yeah. Then we multiply by standard rate.
Great.
You see that? So how do we get budgeted hours?
Yeah.
We have standard hours, right? Per unit.
Yeah.
So we use the
Yes.
standard hours per unit to multiply what? Budgeted output.
Budgeted output.
You get it? So 2 multiplied by 5,000,
Okay.
that gives us 10,000.
10,000.
And then the actual hours, we have what? 4,980.
Actual hours is 10,500.
Correct one. Sometimes you have to intentionally make a mistake to see your people are following. So that's great. So that'll be 10,500. And then standard rate. What is the standard rate? So the standard rate will be the budgeted cost divided by standard hours. You get it? If you want standard rate, once you have your budgeted, you know that we always say the budgeted hours multiplied by standard rate will give you what? The budgeted cost. You get it? And now we have the budgeted cost to be 25,000.
25,000.
And then the budgeted hours is what? 10,000.
10,000.
So we can say this Y. So if you want SR, we only divide the 25,000 by 10,000. That will give us what? 2.5. And that's the standard rate.
2.5.
Do you understand?
Yes.
All right. So standard rate is what? 2.5. So all multiply by 2.5.
2.5.
Yes. If you like, Krano, even if we are doing the standard cost card, right? And we have fixed production overhead. So the standard hours is what? 2 hours, right?
2.
So we don't know the standard rate. But we know that when we multiply that, we are going to get what? The standard cost per unit, right? So if you want the standard cost per unit, you divide the budgeted cost by the budgeted output. So divide and let's see. So 25,000 by 5,000.
5.
All right.
5.
So 5.
Now,
So it means
medium
that
class.
the standard cost, the standard fixed production overhead for a unit is what? Is 5. So based on that, we can now get the rate. You get it? So what do? You divide 5 by 2. That'll give you the rate. Anything that when you multiply with 2, you get 5. And that is what? That will be 2.5. So you can devise various means to get it. Either you use the output or the hours. You will still get 2.5. Okay. So how much will you get? 500 times 2.5. That will give us what?
1,250.
Adverse.
So ideally, we will say that
Adverse.
we will say the hours has increased, so it is adverse. But we said that for those starting with budgeted hours, capacity and volume, the opposite is the case. Otherwise, we will say that the hours is increasing, so it's adverse. But because you remember that, so we say it's favorable.
Yeah, yeah.
All right. Can we continue? Can we continue?
Yeah.
Can I clean?
Yeah.
Yes.
All right.
Yes. Hmm. The sacrifice is scary.
All right. So we have the
Hmm.
next one is what? Fixed overhead efficiency. Fixed production overhead efficiency. So that was what? Standard hours minus actual hours. We multiply by standard rate. So how do we get standard hours? It is the standard hours per unit multiplied by what? Actual output. Right?
Yes.
All right. So what do we get? 9,000.
960.
Sorry, 9,000.
960.
All right. Then the actual hours is 10,500. Standard rate is what? That's what we calculated, 2.5. So what do you get?
One 350.
That's the Bible you should put the pages. This is
50 advert.
No, thank you.
1350. And then the hours are increasing, so it is adverse. Are we okay?
Yes.
Yeah.
All right. So now we move on to look at what? Fixed overhead volume variance. So volume variance is what? Budgeted hours minus standard hours. We multiply by what? Standard rate. Budgeted hours, we've worked out already. We had what, 10,000. Standard hours, we've looked at it, 9,960. Standard rate is what? 2.5. Hello?
Hi.
Hello.
Okay, I went off, but I'm back. All right, so what do you get? I hope you were following.
Yeah.
All right, so what do we have for volume variance? 90 or so.
40.
Times the 2.5.
100.
All right. So that will be 100. Favorable or adverse? Ideally, it will be favorable,
Favorable.
starting with.
Mm-hmm.
So we say,
It's supposed to be so if adverse.
you get
So
it. Ideally,
question or yeah.
yeah.
So is it anything under the fixed production overhead cost variance is the opposite?
No. Oh, we said
Because
that
this is volume.
only volume and capacity. And we said, even look at their formulas. They both start with budgeted hours. So I said that put it in
Okay.
mind. Once it starts with the budgeted hours, then the opposite, when you are interpreting it, the opposite is the case. It's only
Mm.
those two. The rest, normal interpretation.
Okay.
You get it? So those two, capacity and volume.
Yeah.
And they also start with budgeted hours.
Okay.
All right. Then the last but not the least is what? Production overhead variance. So production overhead. So that will be fixed production overhead cost variance. So standard fixed production overhead cost minus actual fixed production overhead cost. So how do you get the standard fixed production overhead cost? You remember we did the standard cost card here, right?
Yeah.
And we had
Yeah.
the standard cost per unit to be what? The standard cost per unit, what did we get? Do you copy or do you copy?
Yes, but I didn't copy that one.
All right. So we said that fixed production overhead cost will be 2 hours at 2.5, and that will give us 5. You remember?
Yes.
So if you want the standard fixed production overhead cost, we use this 5 to multiply what? We will use the 5 to multiply what? Oh, standard. We will use the 5 to multiply what? Can you hear me? Hello? Hello?
Hi.
Yes, so we said that.
Please, I can't see the screen though.
Please, we can't see the screen.
Okay, all right. I'm coming. Let me share the screen. Can you see now?
Yes. Thank you.
Yes.
All right.
Thanks.
So I was asking if you want the standard fixed production overhead cost, we will use these 5 to multiply what?
Standard fixed production overhead cost. Production overhead cost. The standard fixed.
But do you understand this?
The actual units.
Do you understand it? This.
Standard fixed.
Hello?
Yes.
Do you understand this?
Yes.
Hello. Yes.
Yes. So if you want standard fixed production overhead cost, and I'm asking, what do we use these 5 to multiply in order to get the standard fixed production overhead cost? Sorry?
Is it the budgeted output?
For actual units.
Budgeted output.
If you multiply by budgeted output, we are going to get budgeted fixed production
actual
overhead
units.
cost. Hey, but this time, all this stuff we've done, if you don't know that, when you want standard, you multiply by actual output. You want budgeted, you want multiply by budgeted output. Then there's a problem. Oh. Are you trying these things at all? My people,
Yeah. Please, I don't need
sorry?
this kind of disturbance when I'm having a lesson. Thank you very much.
Hello, is it?
Hello.
Yes. Hello?
Hello.
Yeah, somebody said something. Oh, okay. So we multiply the 5 with by actual output. So 4980 multiplied by 5. What do we get?
You want me to dance?
$24,900.
24,900. And the actual fixed production overhead cost is what? 25,840.
5,840.
So what do you get? Deduct. What do you get?
$940 adverse. 940.
940. Then that will be adverse.
Adverse.
All right.
Adverse.
Okay. So now see, we know that so volume is made up of capacity and efficiency, right? So if you net this up, you see that you get 100.
Yes.
You see that? Because the volume is made up of capacity and efficiency. So when you net these two, you see that you get 100 adverse.
Yes.
And then the cost is made up of expenditure and then the volume. So 840 adverse, 100 adverse, then you get what? 940 adverse. So even if you get this correct,
Okay.
straight away you see that you are correct. Any question? Any question?
No.
All right. Then I think we solved this Oduma Cement Limited. We solved it, right? This one. This particular question, we solved it.
Yeah, we've done it before.
And then the next one, this one looks like the it's a Pascal April 2023. It's just like what we did last. Was that yesterday or on Wednesday? So you can go and try it. You see that? So this is the actual, and they've given us the variances. The only difference is that the question we solved, they first started with the variances before the actual, but they've now turned it actuals first before the variances. You see that?
Okay.
Yeah. So as simple as that. So please go and try it. And then there is this question too. We have the standard year. They say budgeted information, but it is the standard and then the actual. And they say prepare a standard cost. Even this one, we tried it. We solved it. You remember? Oh, we didn't solve it.
We have solved
We
it.
have
We've solved it. Like timber, we've solved it.
Ply timber manufacturers, we solved it.
Yes, we did.
Okay. So it
Yeah,
means
we
that
solved it.
I do, yeah, sell. So please go and try all this and you'll be good. So quickly, let's move on to look at productivity ratios. Productivity ratios. All right, productivity ratios. So the productivity ratios come under the fixed production overhead cost variance. You see, under that we have what? Fixed production overhead expenditure variance, right? And then what? Fixed production overhead volume variance. And then the volume gives us what? Two more variances. Fixed production overhead
and
capacity variance. And then fixed production overhead efficiency variance. So fixed production overhead capacity variance. So do you remember this? Do you remember this?
Yeah.
All right. So we can put all this in ratio forms. And that is what we call productivity ratios. You see that? So if we are putting them in ratio form, let's see how they. So we start with I'm coming, just minutes. So this one, the volume, we call it production volume, or activity ratio. You see that? And then the capacity, we call it what? Capacity ratio. And then this is known as what? This is known as efficiency ratio. You get it?
Yeah.
Okay. So these two. So these three. So let's quickly see how to calculate these ratios. So they are ratios, but the volume one is known as production volume or ratio or activity ratio. And then the capacity ratio, then we have efficiency ratio. So you can equally call this volume ratio. You get it? All right, let's see how.
Yeah.
So let's start with the efficiency ratio. The efficiency ratio, if you want the variance, it is what? Standard hours minus actual hours, right? Right, you remember? Hello? Hello? Hello?
All right.
Can you hear me?
What? Yeah.
All right. So, Mercy, can you hear? PSA, can you hear?
Yeah.
Mercy, can you hear?
Yes.
All right.
Yes.
So you remember this, that the efficiency ratio, this is how we ascertain it. So the variance. So if you want the ratio, it is very simple. Standard hours over actual hours. Then you multiply by 100. Then you come to the capacity ratio. So that one, capacity ratio. So this efficiency. The capacity variance, how do you get it? Budgeted hours minus what? Actual hours. Then we multiply by standard rate. So remember, as for the capacity and the volume, even when we are interpreting them, the opposite is the case. They don't follow normal, stuff. So here too, they will not follow. Ideally, it will be budgeted hours over actual hours, but we will change it and say actual hours over budgeted hours. Then we multiply by what? 100. The same thing. The volume is budgeted hours minus standard hours. By here, it will change. Volume ratio. It will change to what? That be standard hours over
Standard hours over
Budgeted
budgeted
hours.
hours.
times 100. So these are the formulas. Once you are familiar with these formulas, then good to go. Are we okay? So this is how to calculate them.
Yeah.
Now let's pick a past question, a sample question and solve. So let's look at the the sample questions. Let's look at question 6. All right, someone should read for us question 6.
A or B? A B, right?
Yes.
Ghana National
No,
Gas
let's
Company
do
is
both.
a gas.
Sorry, let's do both. Do the A, then we do B.
With regard to variance analysis for all production costs, direct material, direct labor, and overhead, it is important to note that each variance does not represent a separate and distinct problem to be handled in isolation. All variances in one way or another are independent. 1. Explain what you understand by the term interrelationship between variances. 2. Explain possible reasons for interrelationship between material variances and labor variances. Support your answer with examples.
All right. So when we say interrelationship between variances are such that when you calculate one aspect of variance and it is positive, then the reason why it is positive may be because another related variance is negative. For instance, assuming you are in business and you are going to buy material, and then you budgeted. You budgeted that when you are going to buy the material, you are going to use 200 kg of material, and you are going to buy it for maybe 10 cedis per kg, right? You get it? And you go to the market and realize that
Yes.
you go to the market and realize that, oh, there are some other quantities on the market which are very cheap. In fact, you can get some at 2 cedis. You see, so you go and buy 200 kg at what? At 2 cedis. Then when you bring it and start to do the work, you see that the 200 cedis, the 2 cedis one you went to buy, it is inferior. It is not of a good quality. And so therefore, you need more of that to be able to do the work. So you later realize that you need 900 kg of, or you even need, maybe you need 1,050 of the kg before you can even do the work. Do you understand where I'm coming from? Hello?
Hi.
Yes. So you see that when you are looking at, so when you are looking at your variances, then based on this, you also have a labor you budgeted for. All right, so You also have a labor. And then you could also say that, oh, you are going to use 2 hours of labor at 20 cedis to do the work. And later you see that you have to use maybe 8 hours of labor at maybe 20 cedis to do the work. And the reason why, so this is budget. And this is actual. So the reason why you now require 8 hours is that the material you bought, the quality is not good. So you realize that those who are working on the item, who are producing the item, they need to take their time. If they go by using 2 hours, they will lose all the material. So they need to take their time. And so they need 8 hours to be able to work with that material. So you see that when you calculate your material variance and you come and calculate your labor variance, you see that the labor variance, whatever you'll be getting, will be as a result of the material that you went to buy. You thought you had cheap material, but it is now giving you, it is now letting you spend more time, or it is now leading you to pay more for labor. So even here, we don't need to increase it. For here, we can even assume that when you went to the market, you realize that you can even use the same 200 kg, but even you are going to get it at 2 cedis. So you can even use it. But here, when you come to labor, I don't know whether what I'm saying, you get it. You are in business. You plan to buy 200 kg of some material at 10 cedis. And you went to the market and realized that the same 200 kg, you were able to buy it at 2 cedis. It was very cheap, so you bought it and you were happy. But when you brought it to your warehouse, you realize that instead of using 2 hours to work in order to produce a unit of whatever you are producing, you now need to use 8 hours because your workers have told you that, boss, your material is not good though. We need to spend more time, otherwise we will spoil whatever we are producing. You see, so you see that the variance you get from labor is interrelated to whatever you get at material. Are we okay?
Yeah.
Yes.
All right. So that is the idea about interrelationship between variances. So whatever variance you get from one element is likely to have an effect on another element of cost, because they are interrelated. So that is the idea. Now, explain with possible reasons for interrelationship between material variances and labor variances. So that's an example I gave you. So they want you to give how material variances can interrelate with labor variance. So I've given one example that you go and buy cheap material than you anticipated. And now your labor will have to spend more time in order to work with those material. You see? So any other example you can also give? Should I give more? Hello?
Yeah.
Assuming you go to the market.
Hi.
Yes. So assuming you go to the market for to buy material, and then you go and buy the material. Maybe you want to produce 10 units of the marker, and you are going to buy material for that 10 units. And you got there and the person selling said, oh, but if you are going to produce only 10 units, then you don't need to buy 100 of the material you are planning to buy. 80 can even do it. So what I say? So he said, you are happy. 80 bet me. And so, oh, yeah, 80 can do it. And then you buy 80 units. Then you bring it to your warehouse. And then the labor you engage, that labor comes to tell you that, hey, maybe I mean to me for 80 you. Maybe I just 100, say 80 no I could tell you I mean to me yet. And then you go back to the person who recommended the 80, and he says, oh, Papa here or high. As for him, he uses 80. And then you go to engage that Papa, and he says that for every unit, he will charge 100 cedis. Meanwhile, the initial person told you that he will charge 70 cedis. Are you getting it?
Yeah.
So
Yeah.
now you gain at the material by not buying 100, but rather buying what? 80. But you are now making up that cost for the labor. That is the meaning of interrelationship of labor. And that's what the examiner, so you just create an example and write it for the examiner. Do you understand? And he's saying between material and labor. So can you create any example where your plan and actual between material and labor can have an interrelationship? But do you understand my examples? Do you understand my examples?
Yeah.
Yeah.
All right. Can you also give some examples, at least one each? Then I know that you understand. You try something, anything.
Mm.
All right. So you can equally go to the market.
So
Yes. For material. Hello.
hello.
Okay,
Hello.
let's continue. I think you understand. So you can also go and read and you get a better understanding. Now let's go to the B.
Okay.
Let's go to B. Yes, who is reading for us?
Sorry. Oh, I didn't know. Sorry, I'm reading.
Okay.
Ghana National Gas Company is a gas processing company and has its plants located in Etiabo in Western Region. The plant produces three gas products: lean gas, liquefied petroleum gas, and natural gas condensate. The standard time for production of the products are LG 40 minutes per metric ton, LPG 30 minutes per metric ton, NGC 45 minutes per metric ton. The budget for the month of February is as follows: LG 45,000 metric tons, LPG 25,000 metric tons, NGC 30,000 metric tons. The actual data for the month were as follows: labor hours 70,000 hours, production LG 48,000 metric tons, LPG 27,000 metric tons, NGC 25,000 metric tons. Required: compute and interpret the following: I, the efficiency ratio; II, the capacity ratio; III, the production volume or activity ratio.
All right. So this a past question 2018. They want us to calculate the productivity ratios. So and interpret same. So we need to, so we have the actual hours here, the actual data. So labor hours. Then we have okay, so let me do this. Do this. So looking at this question, we need to have budgeted hours, right? Then we need standard hours. And then we also need what? Actual hours. You get it? Actual hours have been given as what? 70,000. Have you seen that? Labor actual data for the month, labor hours,
Yes.
70,000.
Yeah.
So we now want budgeted hours. So budgeted hours. So budgeted hours, we have LG, LPG, and then NGC.
NGC.
So if you want budgeted hours, what do we need? All right. So if you want budgeted hours, what do we do? We need the standard hours. They say standard time. So those are the standard hours, right? Right?
Yeah.
So you need the standard hours to multiply what? Budgeted output. You get it? And we have the budgeted output here. The budget
Yes.
for the month of February is as follows. So the output. So LG, we have, so the standard time is 40 minutes. So we change it to hours by dividing it by 60, right? Then we multiply it by the LG budgeted hours, 45,000. Okay? Then we have LPG. The standard time is 30 minutes, so 30 over 60 in order to change it to hours. Then the budgeted output is 25,000. Then we have NGC. 45 minutes divided by 60. Then we multiply it by what? 30,000.
2,000.
So here we have what? 12,500.
First one, 30,000.
Last.
$22,500.
So when you add, or what do you get? Shabu, 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 shabu.
65,000. 65,000.
65.
Yes.
All right. So that is that. Now we come to the standard hours. So standard hours, LG. It will be the same standard time, but now we will multiply with what? Actual output, right?
Yes.
So LG is 48,000. Then LPG 30/60 multiply by what? 27,000. Then NGC. Oh. So we have 45/60 times 25,000. So what do you get?
First one is
32,000.
Sorry,
32,000.
32,000. I think here will be 13,500.
Yeah.
Down.
And 18,750.
So when you add all,
64,250.
all right. So budgeted hours, we have 65,000 hours. And then here we have 64,250 hours. All right. So with this, I can clean here, right? Or I should hold on.
yes.
Hold on or clean.
Yeah, you can clean. You can clean.
All right. Time wasting, say, no problem. Now we can. All right, so let's start. So we should do efficiency ratio. All right. So efficiency ratio,
Yeah.
it is what? Standard hours over actual hours. Then we multiply by what? 100. So we have 64,
100.
250 divided by 70,000 times 100. The Benya saying. Then from there we come to capacity ratio. That one too is actual hours over what? Budgeted hours times 100. So we have 70,000 divide by 65,000 times 100. Then we have activity ratio. So that one too is standard hours over budgeted hours. So we have 64,250 divided by 65,000. The first one, what do we have?
91.79.
91.79.
Sorry, 91.7. 91.79%. Okay,
107.69.
0.8. 0.89.
69.
69.
69.
All right. The last one.
$98.85.
All right. Hello, Gideon. All right. So you see how to calculate this. My people, you see that?
Yes.
So question number maybe it's not here. But if you follow past questions, you see that he repeated the same question some time ago. So this one, so here if you want to translate, so you say here they planned 90 out of the actual hours, which is the 70,000. 91.79% of that had already been planned for. You get it? So the remainder wasn't planned for, wasn't something they planned for. That is the meaning. And then the 107, so they used 7.69% more than they budgeted for. You see that? And then in terms of the plan, if you are considering the two plans, because standard hours is a plan, budgeted hours is also a plan. But the standard hours is based on actual output. And then the budgeted is based on what? Budgeted output. So in terms of the two plans, the one based on actual and the one based on what? Budgeted. So about 98% was based on actual. You see? So this past question, you can read to see what the examiner wrote. But is the calculation that? So it's simple. There are three ratios and you deduce their formulas from the variances we calculate. Except that the capacity and then the volume for the two, you see always the opposite is the case. So you have any question up to this point?
No.
No.
All right. So I think we will pause here. We are now done with the basic variances and all that. So the next time we meet, then we look at advanced variances. Advanced variances.
Okay.
So please, we will do that on Monday.
So I have a question.
Yes.
Last time you brought up the topic, I think profit reconciliation, and then you didn't do it. I wanted to ask why.
Okay, so we didn't do that because, okay, that day okay, then we can quickly look at it. Because the last time, on that day, what I wanted us to use, your other colleagues wouldn't have understood it because of the question I wanted us to use. So now that we are, let me